a company is in focus right now, Jana Small Finance Bank, the recent IPO. Pull up the stock price since IPO, around 470, went to 360 odd, back to 390. But we are talking about, Ajay Kanwal is in our studios right here. We'll talk about how the business momentum is. Ajay, I'm told that you're already readying a trip towards Asia to meet investor friends, all of that. But I want to start our discussion today about something which has happened in the lending ecosystem in the last 2 weeks or so. You've taken a journey from MFI to a small finance bank yourself. Suddenly, there is a lot of regulatory glare on certain section of lenders, mainly NBFCs. Is it risk management measure which RBI is going after? It is some deviation in practices. What is your observation as an industry leader?
So, first, good morning to you. As you know, it's not the first easiest questions to start our meeting with, but I will try.
Sure. Thrown you into the deep end.
It's like the comment on a broader scale. Listen, so I'll give my thoughts. And I think first is it's good to clean the house when things are in good shape. See, when industry has got a bit of challenges, then to try and, solve more problems is very low likelihood. It'll only make things worse. But when everything is going, at least, you look at the NPA levels, you look at growth path, you look at economy, there is reasons to say the banking sector is doing very well. I think in that to figure out where are the small areas you have to tighten, right? I think it's like the right thing to do in my mind, right? And what are the areas to tighten, who best? Because, we have views of our banks or our institutions and our opinions, but he has an overall view, he's got all the data, he's seen a trend, he's seen a few cycles. So I think they are best in their moments to figure out what areas have the potential of future issues. Now that things are good, let's kind of make sure that these things are calmed down or changed or moderated. So I think that to my mind is the way I would think about as a not Jana specific or NBFC or bank specific. On industry side, maybe we are all having good ROEs, we have got good EPS, NPS are low, growth is good. Let's just step back and see where are the areas we can do a bit better on. And I think these are the areas I think which are probably coming to fore, yeah.
So did you also run that kind of an exercise, step back and analyze if all is going well?
See, we certainly did. Because, anything that comes from the regulator, the first thing you would like to see is, he's obviously got a reason for saying it, right? And you got to see that are you right as an institution on those aspects. So we certainly give it importance. I also am in the same phase, which is, Jana is doing well, we've got profits. Okay, now where is the things that either you're underinvested, your things you're doing, you need to really rethink about it. I think there are times you should really go through that. So we certainly pay attention to it. The regulator, of course, had asked for extra capital to put up, whether it's NBFC lending or some amount of consumption lending. So we had to, of course, put extra capital to that. But I think the trend in my mind is pretty clear, saying fix the areas which are supposedly weak. Let's make sure we're going towards productive lending, where people are not just consuming and don't find consumption borrowing very easy. That's my second take out of it. And third is, make sure that this good trend of banking, we sustain it. There is no point of having a great moment and then not a great moment. So I think a lot of this is about sustaining a good momentum, because that's what we need to reach the 5 trillion economy.
Yeah, and you had spoken about that in the past as well, that the focus will be on maintaining your ROEs, keeping NPAs in check. So is that something you guys are doing internally?
So absolutely, which is like, you make I said this earlier, so maybe I have no new ones to say, but you make the worst of loans in the best of times. So you got to keep your head above, you don't let overconfidence come in. And you just make sure you're dealing with a customer, you're making sure end use is correct, you make sure your collateral is right, you're doing the right things. Because if you see the banking industry, credit growth is very good, right? So why won't banks grow? Economy is growing. If you've got a reasonable product range, you will also grow. But make sure it's good growth, both for you and the consumer.
Right. Ajay, now that you're a listed company and we can talk more openly about numbers now, I want to talk to you about one section of the market, raise a question mark about your quality of earnings, saying that yes, the visibility is very strong, but there is a component of deferred tax as well the next 2-3 years, till 27 if I'm not wrong, which will keep on aiding or cushioning your earnings. Can you tell us that how much is that proportion to your earnings visibility from here on? And even if you take conservative accounting practice and adjust it, so X the deferred tax component also, how's the visibility looking on earnings growth?
So thanks for bringing it up. So see, there is two ways you can cut it. We have roughly, if I remember September numbers right, 1,000 crores of deferred tax asset, which go all the way up to 2027. Okay. Now, if I make profits, I will not pay taxes because I've got a deferred tax asset, right? Now, you can count it two ways. You can say, okay, Jana Small Finance Bank's additional net worth is 1,000 crores because they're going to use up this deferred tax asset till 2027, right? And then you can keep minusing from my earnings, 25%. Option A. We can do option B, which is no, I will not count that 1,000 crores extra in net worth. I will then assume he'll make extra profit because he doesn't have tax till 27. Correct? So there are two ways to look at it. The market can choose either. I think the result of both will be very good because that 2,000 crores deferred tax asset is real.
Right.
So that's one. I think now on how are we performing versus peers when it comes to this extra DTA that we enjoy, the deferred tax asset. Then listen, our last December published numbers is a EPS about 20. So you minus 25% out of it is still 15. But I think here is the important piece, is not what we are today.
Okay.
It is more upon what trajectory do you see, and you just take 1 or 2 years fast forward, no capital raise, what will our EPS be? And even if you minus 25%,
Still will be very healthy.
I can tell you that these will be really, really very good numbers. So, and I'm sure all analysts and markets, they're not buying for today.
Sure.
They're buying what is 1 year, 2 years down the line.
So these guys are assuming upwards of 20%, even adjusted for that. Okay, is that a fair estimate?
See, I think I would see we are at 20 today, right? And we all know that we are just, it's our first full year post-COVID.
Yeah.
It is not even our second year. Unlike, and our growth rates, which are published growth rates, our deposit growth rate was 37%, our asset growth was 32%, our profits from 175 crores last year has become 348, 9 months on 9 months. So numbers will tell you that, listen, the trajectory is only on the positive side. And our bias is very simple. We've got a model which works. We want to keep it safe and we want to keep it good. I think the people are probably looking at, if you worry about deferred tax, like you're worried about here and now, then also I think I would do two things. I would minus 25%, then add it to net worth. Because that is cash, no?
So the valuation itself will start looking
So
good.
whichever way you cut it,
Okay.
is going to work in Jana's favor.
But tell me, when you look at your book right now, do you sense or possibly foresee some sort of stress building up anytime soon in terms of your asset quality? Could there be any pockets which could be problematic or troublesome?
So see, from our book, the only asset we monitor more regularly are the MSME segment.
Sure.
Because sometimes some change in export, some dumping from some other country, some change in regulation on pollution, etc. So those could be
They're
the
very
impacted
sensitive to
areas,
it, yeah.
right? But from a consumer era, as long as you're not over leveraging the customer, right? You're being careful about it. You're making sure, as you know, we are 60% secured now.
Yeah.
So your collateral is very well valued. You've transferred it on, the mortgage is marked on the bank's name. It's very well done. Then we don't see stress on the consumer side, but we are very conscious. So, for example, suppose I have a consumer whom I find that he's borrowing from others. I will not give him any more money because it's not about whether he's good, paying me well or not. I think based on his cash flow, he's already leveraged enough. So there is no point me trying to, run behind a customer if I think he's over leveraged. So as long as you're managing leverage, we are not seeing any stress. And we are very watchful on the MSME side. I think that's the only area where things outside a customer's control can impact him. Let's say your payment has not come from a particular contract. Now, there's little you do about it and then I'm waiting for you to get it. So that becomes a bit of a challenge.
And other banks had reported some region-specific issues. You're saying that that's not a worry when it comes to Jana?
So, listen, we haven't seen any region-specific concerns. The question somebody asked us was on MFI business in Punjab, Haryana. We have not seen touchwood any stress. Also, our focus is more around districts than around states and regions.
Okay.
So, we have actually gone and chosen districts we work in, and then we do a concentrated job in those districts. So, we have not seen any region-specific. I mean, our NPS, if you look at March to December, 0.9 has become 0.7. These are net NPAs. Even the gross has come down. So I think we are seeing a book getting better.
I think use of technology also helps in the technology and analytics tell you which are the districts which are much more suitable for better borrower behavior and all of that.
Right.
I would like to close on one comment from you on growth on NIS side. We've spoken about earnings visibility, all of that. Our interaction will help many of the analysts out there punch in numbers in their Excel sheets and figure out where you can land up in 12 months. Hence, I want to understand what is the credit cost outlook for 25-26.
So I'll do two parts to it.
Okay.
First is what is my net interest margin? Because sometimes we look at credit costs and then we do, I spoke to someone who said my credit cost is 1.7 and yours is 2, but his NIM is 3.5%.
Sure.
So it doesn't add up then. So our NIM was 7.6 in March. It is 7.9 in December. So cost of funds have gone up, change of mix has resulted better NIM. Credit cost is roughly about 2.3%. We expect it to come below 2 as time passes, which is next year, very immediately, because all the COVID provisioning is done. So it will get better. But again, see, the important is what is my loss absorption ability? It's a function of my NIM. It's very possible that when I deal with consumers whose balance sheets are not strong, I do make better NIMs and I should have elevated provisioning relative. So if I'm doing prime mortgage, you should expect less provisioning. If I'm doing affordable housing, you should expect more provisioning. That's most natural, right? Customers are very different profiles. So what we have now is a good risk-adjusted return and works very fine. So credit costs will come down, NIMs are steady, and touch wood, we should do fine.
Excellent. Thanks very much for dropping by today. We'll meet again after your fourth quarter earnings.
Thank you. Thank you.
Thank you for
Bye-bye.
being with us. Confident sounding Jana Small Finance Bank, the stock up just about 1/3%.